Good evening, everyone. On behalf of Young and Women Members Excellence Committee of ICAI, I extend a warm welcome to all of you to the Sky High Symposium series. It's a platform created by the committee to share technical updates, enhance non technical skills, and encourage our members to confidently express themselves in public forums. This initiative aims to empower and inspire our members to step forward and make the most of their abilities. The chairman of WIMEC is CA Preeti Savla, who is also the chairman of Sustainability Reporting Standard Boards and vice chairperson of Valuation Standards Board for the year 2023-24. Vice chairman of WIMEC is CA Abhay Chajed, who is also the chairman of Commercial Law, Economic Advisory and NPO Cooperative, and vice chairman of Accounting Standard Boards. This Wednesday program series has been thoughtfully designed to nurture the growth and development of our cherished women and young members. Sky High Symposium is not just about technical updates. It's a platform to cultivate and non-technical skills and empower our members to shine confidently on the public stage. Before we continue, I'd like to share with you all the participants another initiative of WYMEC. This year, for the very first time, the Institute of Chartered Accountants of India is organizing CA Women Excellence Awards to acknowledge the exemplary contribution of our women members in furthering the interest of the profession, industry, and society as a whole. I urge every woman member to come forward and actively nominate themselves for the various categories under these awards. You may visit the wmec.icai.org website for the further details regarding the above program. Now, coming to our today's session. Today's session holds the promise of enlightenment as we all explore the realm of highlights of the 52nd GST Council meeting and key changes. Our speaker for the day, CA Darshika Sayya, a true authority in this field, graces us with her insights. CA Darshika Sayya is a dedicated and accomplished chartered accountant with a strong legal background, holding a recently completed LLB degree. Apt and navigating the complexities of the financial and legal matters, specializing in indirect taxation. She is committed to delivering comprehensive financial solutions and ensuring compliance with the ever-evolving tax laws of our country. Leveraging 5 years of professional experience and trained in GST from the Institute of Chartered Accountancy of India, CA Darshika Sayya offers expertise in this domain while actively engaging in freelancing and practicing GST services. I would like to give a warm welcome to our speaker, Ms. CA Darshika Sayya. Thank you. Over to you,
Yeah.
ma'am, Darshika, ma'am.
Yeah. Thank you. Thank you so much. I thank the committee. I thank the committee, CA Preeti Savla, chairpersons, vice chairman, the committee members, the coordinators. Thank you for giving me an opportunity to share my views on this subject. So, as we say, the topic for today is highlights of the 52nd GST Council meeting and the changes that in GST law which would be effective from the 1st of October 2023. This meeting has been conducted on the 7th of October under the chairpersonship of Srimati Nirmala Sitaraman. Yeah. Sorry. Yeah, I will. Yeah. Yeah. Is this okay? Yeah, sorry. So, today's topic is the highlights of the 52nd GST Council meeting and the key changes in GST law effective from 1st of October 23. This meeting was conducted on the 7th of October under the chairpersonship of Srimati Nirmala Sitharaman and in New Delhi and attended by many finance ministers of states and state union minister of finance. So there have been several recommendations in this meeting which we are going to discuss. The first, this is the press release which has been issued. It shows that there have been changes in the GST rates of goods and services. The first change that comes is the GST rate on food preparation of millet flour in powder form containing at least 70% millets by weight, falling under this HS code with effect from the date of notification. It is to be notified. So, one thing that needs to be taken care of is GST rate on food preparation of millet flour. This has to be distinguished from millet noodles, millet, and even if it's used in multigrain form, multigrain flour, we have to check whether the millet content is 70% or not. The rate prescribed is 0% if it is sold in other than prepackaged and labeled form, and 5% if it is sold in prepackaged and labeled form. This was the first change in the rate of goods. Moving on to imitation zari thread or yarn made out of metallized polyester film or plastic film falling under this HS code are covered by the entry for imitation zari thread or yarn attracting 5% GST rate. However, no refund will be allowed on polyester film or metallized or plastic film on account of inversion. This change is to say that imitation zari thread will be taxed at the rate of 5%. The no refund on to be allowed on polyester film on account of inversion. One thing we can think of is that can be a possibility of inversion. What is the meaning of inversion now? Inverted duty structure is one wherein the output is taxed at a higher rate compared to the inputs. So there could be a situation wherein the polyester or plastic film may be charged at a higher rate, which is used as an input for this zari thread. For example, like 12%. And when this imitation zari thread is at 5%, there would be no refund granted on the inputs, that is the polyester or plastic film. This is what we can think of reading this recommendation. Moving on to extra neutral alcohol. This is a very, very big change that has come in the 52nd council meeting. Now, what is the purpose of extra neutral alcohol? Extra neutral alcohol is used for the manufacture of alcoholic liquor, which is used for human consumption, has been recommended to be kept outside of the GST scope. Law committee will examine suitable amendment to exclude ENA for use in manufacture of alcoholic liquor for human consumption from ambit of GST. Now, I would like to put more light on this. Extra neutral alcohol is the basic ingredient which has been used for manufacture of alcoholic liquor. It has been kept, it has two uses. One, it is used for manufacture of alcoholic liquor, and secondly, it is used for industrial use. So the ENA which is being used for industrial application will be taxable at 18%. There is no change in that. But now we have to think of this ENA which is used for alcoholic manufacture of alcoholic liquor for human consumption. Why it has been kept outside the GST scope? If anybody is aware of a recent judgment of the Allahabad High Court, there was a recent judgment in the Allahabad High Court in the case of Jain Distillery Private Limited versus the state of UP. It has been said that alcoholic ENA is not a vatable product. No VAT will be charged on ENA. If there is this article 366(12)(a) of the Constitution of India, wherein goods and services tax, it is mentioned that goods and services tax would be levied on all types of goods and services, except there's only a single exception to the entire framework of the GST law, which has been mentioned in the Constitution of India, and that is alcoholic liquor for human consumption. This is specifically mentioned in Article 366(12)(a) of the Constitution, which is the government is said that it would not tax alcoholic liquor under GST, come what may. So, what is the logic behind keeping ENA outside the scope of VAT? In the VAT judgment in the case of Measures Jain Distillery Private Limited versus state of UP, it was held that when ENA is not a vatable product because alcoholic liquor for human consumption is liable to VAT. Because ENA is not alcoholic liquor, it is not alcoholic liquor for human consumption. So, it is not liable to VAT. Now, it was the time for the GST Council to think on this ENA. ENA has been a GST-able product. But now the council has removed it from GST also. This means there is neither VAT nor GST applicable on extra neutral alcohol. Can anybody guess why is this? Why anybody would do that? Because of the recent judgment of the Allahabad High Court, everybody is aware it is not liable to VAT. Now the council has recommended that it should also not liable to be under GST. The only logic that we can come across is this is a classic example of cooperative federalism. What is cooperative federalism now? States are the Article 246(a) of the Constitution of India gives 3 lists for taxing purposes. Union list, wherein the center would take the be eligible for the tax revenue. State list and a concurrent list. ENA, alcoholic liquor for human consumption, would fall under the state list. There's only item which falls under the state list. Now, when alcoholic liquor, the major input is liable to GST, GST becomes cost to the manufacturers of alcoholic liquor. So, now this being out of the GST scope, ENA, the cost of inputs would come down for manufacture of alcoholic liquor. When the cost of alcoholic liquor manufacture comes down, the states would be in a better position to charge VAT. Now, the center has ceded its right to tax GST. So, and it's the state's prerogative to tax alcoholic liquor. So, this is a classic example wherein center is ready to forego its revenue when it has given a free hand to the states to charge alcoholic liquor as per their own wish. There would be a difference in the rates in all the states, but that is how it used to be in the VAT regime. and a law committee will examine a suitable amendment in law. So this law committee also will amend the law and exclude ENA for use in manufacture of alcoholic liquor. That only thing that comes to our mind is now they are supporting the liquor companies with there are few more recommendations. They are supporting the liquor companies, reducing the cost of manufacture so that each respective state can tax as per their own requirement. Alcoholic liquor, state excise, VAT, everything would be taxed according to the state's requirements. Coming up to the next recommendation of the Council, reduction of GST on molasses from 28% to 5%. Molasses is also an ingredient for manufacture of alcoholic liquor. Also, as we discussed earlier, one more step in reducing the cost of alcoholic liquor manufacture. The Council states this step of reduction of GST on molasses from 28% to 5% will increase liquidity with mills and enable faster clearance of cane dues to sugarcane farmers. This will also lead to reduction in cost of manufacture for cattle feed, as molasses is also an ingredient in its manufactures. So a welcome step, as the reduction on GST will help the sugarcane farmers. A separate tariff HS code has been created at 8-digit level in Customs Tariff Act to cover rectified spirit for industrial use. This is the ENA, which is being used for which will be used for industrial purposes. So a separate HS code has been created. Moving forward, changes in GST rate of services. Entries at serial number 3 and 3A of notification number 12 by 2017 central tax rate dated 28 June exempt pure and composite services provided to the central, state and UT governments and local authorities in relation to any function interested to Panchayat municipality under Article 243G and 243W of the Constitution of India. The GST Council has recommended to retain the existing exemption entries with no change. In this, regarding this exemption, there have been multiple discussions which have happened in the past GST meetings on this council meetings also, whether to extend the exemptions for services, pure and composite services provided to the central, state and UT government and local authorities. In relation to any function entrusted to Panchayat or municipality under Article 243G and 243W. This Article 243G and 243W are wide in their scope. They provide for various social aspects like social services like health, education, water supply, many of them. The scope is wide, and when any service is provided to the central and state governments, it would be exempt. Now there is a clarity. Similarly, the GST Council has also recommended to exempt services. Now, there are only 5 services in this exemption. GST Council has recommended exempt services of water supply, public health, sanitation, conservancy, solid waste management, and slum improvement and upgradation supplied to governmental authorities. So this governmental authorities, when the notification came in 2017, this was not a part, governmental authorities. Then governmental entities were included. At present, currently, the services supplied to governmental authorities was taxable. Now, with this recommendation of the council meeting, these 5 services, only the 5 services which will be supplied to governmental authorities would be exempt. Moving further, there are other changes relating to services. Job work service for processing of barley into malt attracts GST at the rate of 5% as applicable to job work in relation to food and food products and not 18%. So now we'll have take the job work services for processing of barley into malt. Barley into malt is done basically for manufacture of alcohol again. So it was taxable at the rate of it is job work services are taxable at the rate of 5%, and it is not it will there were notices which were being issued stating that conversion of barley into malt is not a food or food product, and hence it should not be taxable at 5%. It should be taxable at 18%. However, this clarification is a welcome move, because now job work services for processing of barley into malt will be charged at the lower rate of 5%. The barley needs to necessary job work is an essential component. Job processing of barley into malt is an essential component for beer production, and without which it's not possible. So again, a welcome move to the manufacturer of alcohol, and thereby enabling the states to charge more state VAT on it. Moving further, with effect from 1st January 22, liability to pay GST on bus transportation services supplied through the electronic commerce operators has been placed on the ECO under Section 9(5) of the CGST Act 2017. So, what is Section 9(5)? Section 9(5) of the CGST Act is the reverse charge mechanism. To explain the reverse charge mechanism in simple terms, would say when there is a buyer of goods and a seller of goods. When the liability to pay tax or liability to pay GST is on the buyer of the goods, in the normal course, it is the seller who pays the GST. But under reverse charge mechanism, it is the buyer of the goods that pays GST. So, the bus transportation services they were supplied through ECO were placed under were taxable under the reverse charge mechanism. This trade facilitation measure was taken on representation of industry association that most of the bus operators supplying service through ECO owned one or two buses and were not in a position to take registration and meet the GST compliances. So, for small service providers where they had only one or two buses, they were not in a position to comply with to meet the cost of compliance GST compliances. So the liability was placed on the electronic commerce operators to pay tax under the reverse charge mechanism. However, as a result of this, the big players were not in a position to take credit of the inputs that were used by them in the supply of services. Thus, to arrive at a balance between the need of the small operators for ease of doing business and the need of large organized players to take ITC, GST Council has recommended that bus operators organized as companies may be excluded from the purview of Section 9(5) of the CGST Act. This would enable them to pay GST on their supplies using their ITC. In simple terms, when bus transportation services are provided by registered persons or companies, they would be liable to charge tax under forward charge mechanism, and the small service providers can continue with the current system of paying GST under reverse charge mechanism. There is further one more clarification regarding the District Mineral Foundation Trust set up by the state governments across the country in mineral mining areas. These are governmental authorities and thus eligible for same exemptions from GST as available to any other governmental authority. What are these District Mineral Foundation Trusts? District Mineral Foundation Trusts are set up by the state governments in economically backward mineral mining areas. These trusts provide services like education, health services. They provide services of supplying pure water, pure drinking water, and many other such services for the welfare of the for the welfare of the mineral mining areas. Now, the five services that we discussed here, services of water supply, public health, sanitation conservancy, solid waste management, slum improvement and upgradation, supplied to governmental authorities are exempt. The same exemption has been carried forward to the District Mineral Foundations Trust. This is a very welcome step because these trusts are for really for the social welfare, a step taken for the social to meet the social welfare obligations. Moving forward, supply of all goods and services by Indian Railways shall be taxed under forward charge mechanism to enable them to avail ITC. This will reduce the cost for Indian Railways. So, Indian Railways are liable to tax for the goods and the passengers that they carry now. They are liable to tax under the forward charge mechanism. Also, there are certain services which are liable to be wherein the Indian Railways is liable to pay tax under the reverse charge mechanism. However, now all the services provided by the Indian Railways, all the goods as well as services provided by the Indian Railways shall be taxed under the forward charge mechanism. This calls for a major change in the processes of the Indian Railways. The systems will need to meet the change in this situation. This is also a welcome step as it will reduce the cost of for Indian Railways when it is able to avail ITC. The cost would reduce and thereby benefit the public at large. Moving further, trade facilitation measure. This is a trade facilitation measure, the amnesty scheme for filing of appeals against demand orders, wherein in cases where appeal could not be filed within the allowable time period. The new amnesty scheme has been brought in for filing of appeal against demand orders, which have been decided for until the period 31st March 2023. The amnesty scheme will be available until 31st January 2024, wherein wherein people have not been able to file an appeal due to the appeal being rejected on account of being time barred, wherein the limitation period has crossed and they were not able to file an appeal. This is a welcome step for the taxpayers. However, on meeting with this condition, the pre-deposit of 12.5% would be charged. As we all know, currently the pre-deposit of 10% is needed to be paid from the electronic credit ledger or the cash ledger. Now we are able to utilize the electronic credit ledger in order to pay the 10% pre-deposit in case of appeals. Now the 10%, this amount remains the same, this condition remains the same. You will be able to utilize 10% electronic and from the electronic credit ledger. However, the amount over and above this 10% of 2.5% will be needed to be paid from the cash ledger. Cash needs to be paid. So this is a welcome step for the trade. However, the work of the officers, GST officers, would increase multifold, and I don't know how they will be comfortable in passing, letting. This would be there would be a challenge. This would be a challenge. I don't know how this recommendation would pass in the next meeting. Further, clarification regarding taxability of personal guarantee offered by directors. This is the major point that used to come in multiple audits conducted by the department. This was a point wherein personal guarantee was offered by directors. The general trade terms are directors need to offer guarantee to the banks against the credit limits or loans being sanctioned to the company. Also, in certain cases, corporate guarantees are provided by holding company to its subsidiary company. So, here we are talking about two types of guarantees. One is the personal guarantee that is offered by directors to banks and in order to obtain loans for the company. Another guarantee we are talking about is the corporate guarantee, wherein the holding company is required to stand as a guarantor for its subsidiary company. There's no GST. In case the clarification that is going to come in this regard is that the council has recommended no GST should be charged for personal guarantees offered by the directors in case of obtaining loans for the companies. See, there's no consideration is paid by the company to the director in any form, directly or indirectly, for providing personal guarantee to the bank or the financial institutes. Hence, it should not be liable to GST, and open market value, OMO, of the transaction is zero. Now, why OMO? This is a transaction between a related company, a related party, related and distinct persons. So, the transactions between related parties is taxable at the open market value as opposed to transaction value. And there is subrule 28(2) to be inserted to be provide for taxable value to be 1% of the guarantee amount or actual consideration, whichever is higher. We all know that as per rule 28 subclause 1, there is a second proviso to rule 28 subclause 1, which states that when the party is eligible to take credit, input tax credit, when the related party is eligible to take input tax credit for any of the transaction, any amount charged on the invoice would be acceptable as the open market value. However, with this clarification, we think that this clarification, which subrule 28(2), which is going to be inserted to provide for taxable value to be 1%, this is a non-obstante clause. It will override rule 28 subclause 1, second proviso, and it is mentioned that the taxable value shall be 1% of the guarantee amount or the actual consideration, whichever is higher. So, concern over here is there are many transactions, for example, power companies, wherein the guarantees are high. The guarantees vary from transaction to transaction, from every proposal to proposal. And the guarantee amounts are also, the loan amount is also high, and the 1% of the guarantee amount would also be a major portion, and GST on that would be a cost to the company. But let's see, we'll wait for the further clarifications to come in. Yeah, moving forward to the restoration of provisional attachment of property. So, as per section 83, which provides for provisional attachment of property, the attachment of property is done by the GST council, by the GST authorities, passing a form, giving instructions to the bank, and wherein the property is attached. The proposed amendment, this attachment is valid only for 1 year, and after 1 year, the property needs to be released by the banks. However, in practical situations, the GST authority banks were not getting instructions from the GST authorities even after expiry of 1 year. So, this amendment is also a result of one High Court judgment, wherein it was the High Court has directed the GST authorities to make relevant changes in Form TRC 22 and the mechanism wherein the taxpayer should not have the hassle due to the procedural lapse. So the GST Council has proposed amendment to provide that the order passed in Form DRC 22 shall not be valid for more than 1 year from the date of the order. It means that after the expiry of 1 year, there would automatically lapse. This attachment of property would automatically lapse. This implies automatic restoration with no further written order required from the authorities. This also comes as one of the tax-friendly measures. Further, issues relating to the place of supply. Clarificatory circular shall be issued for transport of goods by mail or courier where the location of the supplier or location of the recipient of services is outside India. Clarificatory circular, this issue has been faced because recently from 1st October 2023, the place of supply rules have been amended. IGST place of supply rules have been amended. Section 13(9), Section 13, which guides where the location of the supplier and location of the recipient is either of the location of the supplier or location of the recipient is outside India. The transport of goods by mail or courier was the destination of the goods. This has been cancelled now. With this change in the IGST notification, there are the mail and courier services, the mail and courier agencies are getting a lot of notices. What has happened is transport of goods, including by mail or courier, where there is an exclusion for mail and courier in Section 13, subclause 9. And now with deletion of this clause, because it was already excluded in Section 13(9), the GST authorities are not putting it into the general Section 13(2), wherein the location of the place of supply would be location of the recipient as per Section 13(2). The GST authorities claim that since mail or courier are performance-based services, so now the location of the mail or courier would be guided by Section 13(6). They are applying the logic of performance-based services, wherein I'll again repeat, transport of goods by mail or courier where the location of the supplier or location of the recipient is outside India. Where here the mail and courier services were getting notices stating that since the location is there was an exclusion clause in Section 13(9) where mail or courier services were excluded, so they did not even include it in 13(2). Now they want to charge them under performance-based services, and when, for example, we go and give a courier to be delivered outside India, there is some portion of the service which is being performed in India. Thus, as per Section 13(6), even if a part of the taxable service is performed in India, the entire transaction would be leviable to GST in India. They are applying the logic of Section 13(6) and thereby trying to charge GST on transport of goods by mail and courier. Thus, a clarificatory circular will be issued to settle this matter. Similarly, supply of advertising services. Why a circular needs to be issued for this also? Supply of advertisement services. For example, I am a multinational company. I want to place my advertisement everywhere in India. In some places, the services would be on tower. Some places it would be on movable material. So they have come up with notices stating that because it is on a tower, it is services in relation to immovable property. And when it becomes services in relation to immovable property, the supplier would charge C plus S, wherein the recipient wherein the tax would go to the state authorities, and the recipient of service will not be able to take the credit of it. So a clarificatory circular will be issued in case of supplying of advertisement services, supply of co-location services, and transport of goods by mail or courier as well. issue of clarification relating to export of services. There would be a circular to clarify the admissibility of export remittances received in special INR Vostro account as permitted by RBI for the purpose of consideration of supply of services to qualify as export of services. As export of services, as per section 2(6), we know that export remittances received in foreign currency and remitted in Indian currency as permitted by the RBI. So, as per section 2(6), also in Indian remittances permitted by RBI are considered as valid exports. However, when the exporters used to go to take the refund, the field authorities were rejecting the refund because of lack of FIRCs and BRCs. FIRCs is the Foreign Inward Remittance Certificate, which we don't get when the remittance is in INR. As a result, the refunds used to get rejected. Thus, to settle this matter, they have issued a clarification stating that the export remittances received in special INR Vostro account are also permitted for the purpose of refund, and it would qualify as export of services. Moving further, supplies to SEZ unit or SEZ development on payment of IGST and claiming of refund. This clarification is coming in the wake of notification number 1 by 2023 dated 31st July 2023, wherein suppliers to SEZ units or SEZ developers can also go for the IGST payment and refund route with effect from 1st October 2023. This notification number 1 2023 is mentioned that supplies for export and export related and zero rated supplies on payment of IGST and claiming of refund. There was no mention of supplies to SEZ units. Thus, in order to settle the anomaly noted by this notification number 1 by 2023, there's a clarificatory move which has come, which states that now even when you supply to SEZ units or the SEZ development on payment of IGST, you can pay IGST and then claim the refund of the IGST and you unutilize input. This is only this is only to settle the anomaly in this notification number 1 by 2023. Other things, other supplies like tobacco, pan masala, etc., they still remain under the LUT route. Then there are other measures pertaining to law and procedures which have been recommended by the 52nd Council meeting. The alignment of the provisions of the CGST Act with the provisions of the Tribunal Reforms Act in respect of appointment of president and member of the proposed GST appellate tribunals. The eligibility and the age criteria has now been specified. So this recommendation has come due to a writ petition which has been filed by Shri Arvind Datar, wherein the GST, the provisions of the GST appellate tribunal are governed by the CGST Act. So the concern was why the advocates cannot be a judicial member of the appellate tribunal. Now, this writ petition has come now. As per the decision of this matter, now the GST provisions will be aligned with the provisions of the Tribunal Reforms Act. The Tribunals Reform Act states that advocate can become a judicial member, and also the age, eligibility and the age criteria. As per the GST law, the eligibility for the president and the members was 67 and 65. Now, with the provisions of the tribunal, in order to align with the provisions of the Tribunal Reform Act, the eligibility and the age criteria has been changed to 70 years and 67 years. Now, these are in line with the Tribunal Reforms Act, and this gives a big opportunity to the advocates also in the litigation practice of GST. Amendment to Act and Rules to to give effect to ISD procedure. The ISD distribution procedure was mandatory for distribution of input services procured by the head office. In relation to the same, amendments have been made recommended in Section 261, Section 20 of the CGST Act and Rule 39 of the CGST Rule. Now, this ISD distribution procedure was also discussed in the 50th GST Council meeting, wherein, once again, in the GST Council meeting, wherein it was stated that the ISD procedure would become mandatory for the purpose of distribution of input services procured by the head office. What happens in many cases when the branches are placed in different states, there are services, common services, which are utilized by the head office as well as the branch offices also, like statutory audit fees, advertisement services. There was a CBIC FAQ on banking, wherein it was mentioned that cross charge would be sufficient compared to the ISD distribution procedure. Now this matter is settled here. ISD distribution has been made mandatory for the distribution of input services procured by the HO. Now this the mandatory ISD registration needs to be taken, and the issue of cross charge versus ISD gets settled over here. Now there have been multiple changes which are being effective from the 1st of October. These many changes have been given by the 52nd Council meeting. Now, for recommendations have been given by the 52nd Council, GST Council meeting. Moving further, the changes effective from 1st of October 2023. These are Finance Act sections compared to GST sections, and the positions pre-amendment and the post-amendment we are going to discuss. Coming the first change is in Section 10. Before the amendment, and Section 10 is the composition suppliers, section for composition suppliers. Any person engaged in making any supply of goods or services through an electronic commerce operator who is required to collect tax at source under Section 52. Here, the word goods shall be omitted. What does this amendment mean? This amendment means Section 10 of the CGST Act has been amended to remove the restriction on composite dealers for supply of goods through e-commerce operators. However, restriction for supply of services shall still continue as earlier. What used to happen earlier was any person, composition scheme, I'll give a basic understanding of the composition scheme. Composition scheme is for small suppliers who are supplying either goods or services. There were certain restrictions that their suppliers should not be through, there should not be interstate supply. The supply should not be through an e-commerce operator. The suppliers should not be a casual person, and there should not be import of goods. There are certain conditions. Section 10.1 mentions is the section for composite supplier of goods. Section 10.2 mentions the conditions wherein you can take the benefits of Section 10.1. The new Section 10.2a was inserted for the supply of services, where person is engaged in supply of services. Now, with this amendment, any person making intrastate supply of goods can do so even through when he is supplying goods through e-commerce operator. However, the restriction for supply of services shall continue. Now, the person cannot make supply of services from e-commerce operators. Only suppliers of goods who are making interstate supply of goods, intrastate supply of goods through e-commerce operator, this now can avail the composition scheme. Previously, composite suppliers were not. Composite suppliers were not eligible to sell through online platforms. Now, this restriction has been done away with. Intrastate supply of goods And mind you, this is only goods. This is not applicable to services. Only supplier of goods can take the benefit of composition tax. There has been a change in section 16.2. See the CGST section 16.2. 16.2 is the section that provides for input tax credit eligibility. Prior to the amendment, there was a proviso which stated that where a recipient fails to pay to the supplier of goods or services or both other than the supplies on which tax is to be payable on reverse charge basis, the amount towards the value of supply along with tax payable thereon within a period of 180 days from the date of issue of invoice by the supplier, an amount equal to the input tax credit availed by the recipient shall be added to his output tax liability along with interest thereon in such manner as may be prescribed. This used to mean that where a supplier of goods has there is a buyer and a seller of goods. The situation is, in simple words, the situation is that where is a buyer and a seller of goods. The buyer has taken the goods from the seller and now he is not able to pay within 180 days. In that case, the ITC which has been availed by him, when he buys goods, he is definitely going to avail the ITC on the goods. The ITC was required to be added to his output tax liability, which means it was to be added in his GSTR 3B and GSTR 1. Output tax liability was to be shown in 3B and 1 along with the interest thereon. Now, the pre-amendment provision provides for payment of ITC as addition to output tax, whereas post amendment it would be payment or reversal of ITC. When the purchaser or the buyer recipient is not in a position to pay within 180 days, he need not increase his output tax liability. What he can do is reverse the ITC taken. Thus, this would not have major impact on the impact on the finances would still remain the same. However, the liability financial structure would remain the same. The liability of interest on such reversal shall now be determined in accordance with Section 53 instead of Section 51 of the CGST Act. As of now, the interest rate is 18% in both the cases. However, interest under Section 53 has 50 subclause 3 has an upper limit of 24%. So what has happened is there is a recipient and a supplier. The recipient is unable to make the payment to the supplier within 180 days. So what he needs to do now, previously he used to add to his output tax liability and pay interest, add to the tax liability and pay interest at the rate of 18%. After the amendment from 1st October 2023, what he needs to do is he reverse when the recipient is not able to pay to the supplier within 180 days, he has to reverse the input tax credit already taken, and now what he needs to do is again pay interest at the rate of 18%. The sections 50 subclause 1 guides payment of interest on output tax liability, whereas section 50 subclause 3, now it will be guided by section 50 subclause 3, wherein a person who has wrongly availed ITC credit has to pay interest. As of now, the financial component would remain the same to the entire transaction, wherein the interest rate is also at the rate of 15%. But the section 50 subclause 3 has an upper limit of 24%. So 18% can also change to 24% in future. We don't know. Moving forward, Section 17.3, Amendment to CGST Section 17 Subclause 3. Section 17 Subclause 3 is for the apportionment of credit and block credit. What is apportion? First, let us understand what is apportionment of credit and what is the block credit concept. Apportionment of credit, when a person is engaged in supply of taxable as well as other supply, taxable supply as well as other supply, only the portion that is related to the taxable supply, only the credits which are related to the taxable supply shall be allowed. The remaining credits shall not be allowed. That is blocking apportionment of credit, and blocking credit is the blocking of ineligible credit. The credit that is he is ineligible to take on the supplies which are not taxable. Now, Section 17, subclause 3 has an explanation which has been amended. The explanation used to read as follows. For the purposes of this subsection, the expression value of exempt supply shall not include the value of activities or transactions specified in Schedule 3 except those specified in paragraph 5 of the said schedule. What does this mean? We need to understand this is a notable change which pertains to the sale of warehoused goods before filing the bill of entry. According to the notification number 36 by 2023 Central Tax dated 4th August 2023, the value of such transactions will now be included in the value of exempt supply for the purpose of reversing common input tax credit under Section 17, subclause 2, subclause 3 read with Rule 42 and Rule 43. What has happened is for the purpose of calculation of reversal, there is an exempt amount of supply which is considered to be an exempt supply and the amount of supply which is considered to be taxable supply. As per Schedule 3 of the GST Act, CGST Act, there are certain transactions which are considered as neither supply of goods nor supply of services. The schedules of GST Act, I would say there is Schedule 1, 2 and 3. Schedule 1 prescribes for the taxability of goods even when they are received without consideration. So Schedule 2 specified what would be considered as goods and services. And there is this Schedule 3. Schedule 3, which states that their supply would not be considered as even as supply of goods, and neither will it be considered as supply of services. These are non-GST supplies. Schedule 3 supplies are non-GST supplies. So when there is a sale of warehouse goods before filing the bill of entry, now what does this mean? This means that you've imported something. I've imported something from some country. I've placed in my warehouse, which is still in the customs frontiers. I've not cleared the goods for home consumption. Thereby, I have not made any IGST payment for custom clearance. The goods are still in the warehouse, and from the warehouse itself, I'm selling it. I'm exporting it to some other place, or I'm selling it for some other purpose. In that case, this sale will not be considered as a GST. This is a non-GST supply. This will be considered as this is also known as inbound sales, non-GST supplies, and will not be attracting any GST. Now, what has happened for the purpose of reversal of input tax credit? For the purpose of reversal of input tax credit, there is always an amount which is in the numerator and the denominator. The numerator consists of an amount which is known as an exempt supply, and upon the total supply and multiplied by the taxable supply, there is some amount which you get and which has to be reversed. So the exempt supply which is in the numerator will be now the supply of goods which are warehoused before filing bill of entry will now be added to the exempt supply. So I'll repeat it again. There is a proportion in which the credit is reversed. Exempt supplies is in the numerator. So the numerator amount will be added with the amount of sale of warehouse goods before filing of bill of entry. So when the numerator gets added, the reversal would be more. Now the ITC reversal would be more. This would have a consequence on the ITC. Previously, for example, I have a total ITC of 100 rupees. I have a reverse 50% is in my exempt supply. 50 upon 50% is reversal. Now with the change in the with the numerator becoming bigger, the reversal would be more. Now I will get, in short, the credit amount eligible would become less. I hope I'm clear on this now. Moving forward, Section 17.5, subclause Section 17 subclause 5 and a new subclause has been inserted, FA. This is blocking of credit. Section 17(5) is to block credit. Section this now the amendment reads as Section 130 of the Finance Act 2023 seeks to amend subsection 5 so as to provide that input tax credit shall not be available in respect of goods or services or both received by a taxable person which are used or intended to be used for activities relating to his obligations under corporate social responsibility referred to in Section 135 of the Companies Act 2013, which means the input tax credit in respect of goods or services or both received by a taxable person and used or intended to be used, which are used as well as intend whenever they have an intention also to use these goods for activities relating to obligations under the corporate social responsibility CSR activities. The goods and services which are used for CSR activities, they will not be eligible for ITC. So this CSR activities, we understand that every company registered under Section 135 has to make on an average 2% of the net profit of the last 3 years, preceding 3 years, is the amount of CSR, minimum CSR that it needs to expend. Now, this amount, the credit for the goods and services used for CSR expenditure will not be eligible as will not be eligible for GST purposes. ITC will not be eligible. However, on reading between the lines, what I can understand is even if the ITC is not available on these products will be eligible as an expenditure in the profit and loss account, because this is a mandate which has been placed by the Companies Act, and this can be anyway claimed through the profit and loss account. So in my view, it should not make any major difference to the companies. Yeah, moving forward, Finance Act, Section 140, CGST, Section 23. Pre-amendment, persons not liable for registration. The government may, on the recommendation of the council by notification, specify the category of persons who may be exempted from obtaining registration under this act. After the amendment, now, Section 23 is a non-obstante clause over Sections 22(1) and Section 24. Existing Section 23 does not have any clause overriding the registration requirement imposed by Section 24 and Section 22(1). Therefore, a doubt arises whether provisions of compulsory registration under Section 24 prevail over the exemption under Section 23. Now, let's understand what are these sections. Section 22 is the section which prescribes mandatory registration. Section 23 prescribes persons who are not liable for registration. And Section 24, it specifies Section 24, Section 22(1) is a registration on threshold limit. When a person meets the threshold limit, Section 23 is for persons that are not liable for registration, and Section 24 is for mandatory registration. And so now, until now, it used to so happen that Section 23, there are persons who have been mentioned that they are not required to obtain registration, but there was no clarity whether Section 24 would still be Section 24 and Section 22(1) would still be applicable or not. Now, with this clarification, they've made Section 23 a non-obstante clause, and now there is no doubt regarding the validity of Section 23. So, this is This was a needed clarification which has come from 1st October 2023. Sections 37, 39, 44, and 52 of the CGST Act. Moving forward, Sections 37. For GSTR 1, 39, GSTR 3B, 44, GSTR 9, annual return, and GSTR 8 by the electronic commerce operators, Section 52, ECO, shall not be allowed to be furnished. This GSTR 1, 3B, 9, and 8 will not be allowed to be furnished after the expiry of 3 years from the due date of furnishing the statement. So until now, now they have set a limit after the expiry of 3 years from the due date of furnishing of GSTR, no GSTR 1, 3B, 8 or 9 can be furnished after the 3 years from the due date of furnishing the said statement. They are restricting the filing of returns with this. Now, moving further, there is an amendment to Section 30, Rule 23. There has been a time limit for application of revocation of cancellation or cancelled registration was 30 days. Many a times registration used to get cancelled, and the revocation of registration could be done only within 30 days. Now this time limit has been extended. To 90 days, with commissioner having the authority to allow further extensions not exceeding 180 days. This is welcome move for when the taxpayer who wants to revoke his cancellation of his registration. This has been extended to 3 months, 90 days, and then 180 days. This is a welcome measure for the taxpayers. Yeah. Moving further, CGST section amendment to CGST section 109, 110, Constitution of Appellate Tribunals and benches thereof. These amendments are already in place, have been applicable from 1st of August 2023. Now, what has been post these amendments have been given to give a significant clarity regarding jurisdiction, power, authority, constitution of benches, qualifications of president, members has been provided. This is for the Constitution of Appellate Tribunals. So the clarity was needed. Recently, there was a notification in the month of September stating the number of tribunals that would be constituted in each state. So this was a needed move to move the litigation process to expedite the litigation matters. The cases. There's a principal bench which would be set up at New Delhi. State benches would be set up in each state. And one more thing, the cases in which any of the issues, major observation in this is cases in which any of the issues involved relates to the place of supply shall be heard only by the principal bench. Where cases involve place of supply queries would be heard only by the principal bench, which is located at New Delhi. State benches would not be hearing. So this place of supply has been important even in the past, wherein no advance ruling is available in case of place of supply. So similarly here now also only the principal bench will decide matters in relation to place of supply. This is like the High Court and the Supreme Court, wherein only matter of law and can be matter of fact. Law can be discussed in the Supreme Court, and only matters of fact and law can be heard at the High Court. Same way, only the principal bench will decide the matters relating to the place of supply. Moving forward to section 122B. This provides for penal. This section is a new insertion which provides for penal provisions applicable to the electronic commerce operators for allowing supply of goods through it by unregistered person other than exempted persons, allowing supply of goods outside state by composite dealers, fails to supply correct details in return of any supply through it by exempted persons. Now, there are certain persons with this section 23, persons not liable for registration. This section allows people who are unregistered to supply goods through the electronic commerce operators. The persons are unregistered but are allowed to supply goods through the electronic commerce operator on the condition that the electronic commerce operator shall pay tax under the reverse charge mechanism. With the amendment in section 10, that is amendment in section 23, where an unregistered person supplies goods through the electronic commerce operators. Amendment in section 10 wherein a person supplies in wherein a person has to supply goods intrastate through an electronic commerce operator. Composition dealer can supply goods only within the state through the electronic commerce operators. Uh, and uh, and when in the electronic, this is the second condition. The third condition, where a ECO fails to supply correct details in return of any supply through it by exempted persons. Now, the liability is cast on the electronic commerce operators. They have to be more vigilant, more alert regarding the supplies through it by unregistered persons, by persons, composition taxpayers, and whether all the details of suppliers through exempted, all the details are given to it correctly by the exempted persons. In case it does not become alert, it is not vigilant, there is a penal provision of rupees 10,000 which has been placed on the electronic commerce operators. This there's a duty on the electronic commerce operators to check the sellers who are selling goods through their platforms. The amendment in CGST section 132(1). There's CGST section 132(1), the decriminalization of offences. The pre-amendment, the offences were of a criminal nature. Now these offences have been decriminalized. Let us understand what is the meaning of criminal nature and decriminalization of offences. Decriminalization of offences, criminal nature of offences means offences which are punishable with imprisonment, which can be punished with a harsher statement. Decriminalization means the other things would still remain the same. The forfeiture of property, bank attachment, payment of fine, everything would be same, but there will not be prosecution. There would not be prosecution. There would not be immediate imprisonment. There would not be imprisonment. So there are decriminalization of offences and deletion of clauses 132G, subclause G, subclause J, subclause K, wherein section 132 G, J, K, wherein they do not cooperate in the proceedings and all. There is a minimum threshold for launching prosecution to be increased to rupees 2 crores from 1 crore except for fake invoices. So now the minimum threshold has been increased from 1 crore to 2 crore for prosecution. This is also to support the business community. But this relaxation has not been given for fake invoicing because the government has to curb this fake invoicing. So they have not given any relief to the fake invoicing portion. That threshold is still 1 crore. In other cases, the threshold has been increased to 2 crores. The prescribed fees, reading further, also the prescribed fees for compounding of GST offences has been reduced to the range of 25% to 100% of the tax amount as opposed to the earlier of 50 to 150%. However, the option of compounding has been taken away for cases of fake invoicing. What is the meaning of compounding in the first place? Compounding means when a monetary sum is paid in lieu of any other punishment. In simple terms, money is paid in order to avoid other punishments. So previously, there has been a reduction in the compounding amount also. This is also a trade-friendly measure. However, because the government has to curb the menace of fake invoicing, this option has not been extended in this case to fake invoicing. So fake invoicing, 1 crore prosecution, and there is no compounding of offences. It is still 50 to 150%. Fake invoicing still remains the same. In other cases, the threshold limit has been increased from 1 crore to 2 crore, and the compounding from 25 to 100%. CGST section 158A. Section 158A has been introduced with effect from 1st October 2023. It is for consent-based sharing of information furnished by a taxable person. Now, the government whatever information you share, consent is taken from you to share it with other agencies for the purpose of public for the purpose of public welfare, or there will be more transparencies. They want to plug the loopholes. Here the government is in a mood to plug the loopholes everywhere. For example, the e-way bill transactions are interlinked with the FASTag transactions to understand whether the vehicle really passed from that. These governmental agencies are now getting interconnected, and so that to plug the loophole in the tax in the and prevention of tax and prevention of tax being taken away by the persons. I mean, they want to make the system more transparent, and thereby reduce other compliances. Change in Schedule 3. There's a change in Schedule 3, non-GST supplies. The pre-amendment change was supply of goods from a place in the non-taxable territory to another place in the non-taxable territory, warehouse goods to any person before clearance for home consumption, etc. The post-amendment, Section 159 of the Finance Act seeks to amend Schedule 3 of the Central Goods and Services Tax Act to give retrospective applicability to paragraph 7 and 8 of the explanation 2 to the said schedule with effect from the first day of July 2017. No refund if tax is paid from 1st July 2017 to 31st January 2019. This Schedule 3 is a non-GST, no GST. This is neither supply of goods nor supply of services. There were certain entries which have been explained from 31st January 2019, which have been added with from 31st January 2019. The entries belong to the entries read as supply of goods from a place in a non-taxable territory to another place in the non-taxable territory, supply of warehouse goods to any person for clearance for home consumption, etc. These were non-GST supplies. No taxes were payable on this. The explanations were inserted from 31st January 2019. However, there was a confusion from 31st January 19. It was clear that no tax is payable on such supplies. However, there was a confusion, whereas what to do for the supplies which have taken place from 1st July 2017 until 31st of January 2019. So, in order to put to rest this issue, what has happened was there were supplies of warehouse goods for before clearance for home consumption, and people had paid tax on it also. But post 31st January 19, there was a explanation which stated that this would be non-GST supplies and no taxes would be payable. Now, they have from 1st October 2023, they have come up that if there has been any tax, which the important component over here is from 1st July 2017, there was no explanation, and people must have paid tax on such supplies until 31st of January 2019, wherein the explanation was inserted. But now no tax would be refunded for taxes paid on such supplies. And now this also brings a clarity that this amendment is from these explanations have been inserted from a retrospective effect, that is from 1st July 2017. Schedule 3 supplies, Schedule 3, Explanation 7 and Explanation 8 should be considered to be inserted from 1st July 2017. Moving forward. Amendment to Section 2, Subsection 16, OIDAR services. This is the Finance Act Section 160A and amendment. The definition of online information database access and retrieval services has been amended to widen the scope of services. OIDAR services, the condition of essentially automated and involving minimal human intervention, has been removed, making the definition more inclusive. So what has happened is the definition of online information Online Information and Database Access Retrieval Services has been amended with and widened the scope of services. What are these OIDAR services? Now, these OIDAR services, Online Information and Database Access Retrieval Services, are the services which we take online. For example, this Netflix, Amazon Prime, these are OIDAR services which we take and these are essentially automated. Prior to the amendment, these services had to be essentially automated and used to involve minimal human intervention. Now, all over the world, these explanations are being deleted. Essentially automated, involving minimal human intervention. These are subjective terms. Essentially automated. This is not an objective term. This is a subjective term. This and the minimal human intervention. This, even if which now means that OIDAR services would include any services, even if they are not essentially essentially automated, even if they do not have minimal human intervention. So they have made the definition more inclusive. It is a more exhaustive. It covers more services now. It is more exhaustive basically now, and to tax the OIDAR services, to bring more and more services within the scope of OIDAR, this change has been made. Moving to section 12.8, 12 subclause 8, the place of supply of services by way of transportation of goods, including by mail or courier, provided that where transportation of goods is to a place outside India, the place of supply shall be destination of such goods. Post the amendment, what has happened is this section 12 subclause 8. First, let us understand what is section 12 subclause 8 meant for. Section 12 is section 12 of the IGST section. This is IGST Act. Sorry, this mentions as CGST. This is not CGST. This is IGST. This is IGST section 12.8. The place of supply of services by way of transportation of goods by mail or courier. Where the transportation of goods is to a place outside India, the place of supply shall be the destination of such goods. Now, after the amendment, in order to remove the confusion regarding availment of input tax credit and other matters, 12.8 of IGST Act is being omitted so as to specify the place of supply irrespective of the destination of goods in cases where the supplier of services and the recipient of services are located in India. What has happened is, place of supply of service for transportation of goods by mail or courier was the destination of the goods. Now, this has been removed to state that irrespective of the destination of goods in cases where the supplier of service and the recipient of services are in India, in order to remove the confusion regarding availment of input tax credit and other matters of IGST Act has been omitted so as to specify the place of supply irrespective of the destination of the goods in cases where the supplier of services and the recipients of services are located in India, they will be eligible to take the ITC credit. Section 39 of Section 13 subclause 9, the place of supply of services of transportation of goods other than by way of mail or courier shall be the place of destination of such goods. This change has significant implication for the international trade, as services to recipients outside India will qualify as exports and services from suppliers outside India will qualify as imports of services regardless of the destination of goods. What has happened is, there has been a deletion of section 13 subclause 9, which mentioned that place of supply of services for transportation of goods other than by way of mail or courier shall be the place of destination of such goods. Now this clause has been deleted. When this clause has been deleted, the place of supply of service for transportation of goods shall fall under the general principle or general rule subsection 13 subclause 2, which states that the place of supply of service shall be the location of the recipient. Now, when the place of supply is location of the recipient, if it is an importer of goods. He's importing goods from outside India. The person is located in that person is in India. He is also location of the recipient and place of supply is also in India. Then this would be termed as imports. That this would qualify as import of service. This is an import of service. When a person is exporting service, when he is exporting service, he is in India, but the place of supply is outside India. Then this would be considered as an export transaction. After 13.9, Section 13, subclause 9 has been amended. Only it for international trades, in order to classify goods, in order to classify transactions as exports or imports. Moving forward, the much debated, much discussed GST on online gaming. This online gaming was discussed on the previous GST Council meeting also. This council meeting also, they have from 1st of October 2023, the GST rate of 28% on the value of initial deposits staked or chips purchased by players with online real money gaming platforms or casinos will be implemented from 1st October 2023. The GST Council shall review the implementation of this new 28% GST regime on online gaming and casinos after 6 months. The online gaming industry is a nascent industry. It is gaining a lot of attention these days in the recent times. The tax authorities are also are also aware of the growing online gaming industry. The GST Council or the government per se is not interested in giving a boost. This is considered as a sin industry. Not that they do not want they want to curb it totally, but because it is considered as a sin industry, they have charged it at the maximum rate of 28%. There is a hue and cry for taxing this industry, which is still at a nascent stage. There's a famous case of Gamescraft Technology Private Limited. This case is still is under appeal. It's under appeal. What has happened is the online gaming industry, the revenues revenue as per the data is 23,000 crores, and the tax liabilities, the tax department, government has charged 1,50,000 crores to this online gaming industry, charging GST at the rate of 28%, because this clause is applicable from the 1st of October 2023. However, for all the previous transactions also, the GST rate of 28% has been levied on the value of initial deposits. The industry is stating that there was no clarity earlier. The government is stating that the clauses were also mentioned previously. Because there's no outcome, there is no decision yet. We cannot comment on the future of this, but the government is in no mood to give a boost to this industry. That's the reason they have charged GST at the rate of 28% on the value of initial deposits. When you have to initial deposits, take or chips purchase, the entire, if you purchase chips for a value of 100 rupees, you will get only an amount of 72 rupees. This is what we understand. 28% will be the tax which has been charged by the government with online real money gaming platforms, and will be implemented from 1st of October. Because there is a widespread opposition to this, the GST Council has told that we would review after 6 months. They'll review the decision after 6 months. And this decision was not passed by many states. This GST Council meeting, in this 52nd GST Council meeting, which was held on the 7th of October, there were 13 states who passed this notification, and now it is in effect from the 1st of October 2023. The major states that were opposing this decision were Delhi, Goa, the state of Delhi, Goa. These were the states that were opposing the charge of GST at the rate of 28% on the online gaming industry. But as such, they are stating that the revenue is only of 23,000 crores and the government wants to kill this industry by charging 1.5 lakh crores. But let's see how things settle. Everything is under appeal, is with the judiciary, and we'll get a decision in the due course. Now, moving further, the deletion of liability on import ocean freight in CIF import. The deletion of liability on reverse charge on the ocean freight in CIF imports. I would like to put some light on the import transactions. Imports can be of two types on CIF basis. Before I move forward to the amendment, I'll give you a basic understanding of the CIF and FOB value transactions. What are the CIF value transactions? This happens only in case of international trade, imports or exports. Imports, basically. When you import on a CIF basis, you can either import on CIF basis or on an FOB basis. CIF means cost, insurance, and freight. The imports always involve the movement of goods from one place to another place, and during the movement you definitely incur cost on insurance, freight, and the freight charges, cost, insurance, and freight amount. For example, there is a purchaser in India, A, and there is a supplier which is outside India, Mr. B. Here, A decides to import good from Mr. B, who is located in the US. Mr. B here will bear all the expenses of cost of the freight. Freight charges will be borne by Mr. B, and now Mr. A says that, okay, I'll pay you whatever is the amount inclusive of the cost. The goods used to come to A and he used to pay the total amount to Mr. B, including the freight amount. This is a CIF transaction. In case of an FOB transaction, A is purchasing goods from B here on an FOB basis, which means whatever are the charges for the freight, the amount for the he's paying for the transportation of goods and in the insurance, everything is being borne by Mr. A. He is the one who is making the payment for the freight charges. Mr. B leaves the goods on board as it is, and then that's the responsibility of Mr. A to get it collected from the destination from B to A. This is an FOB transaction. What used to happen in now the CIF imports, ocean freight on the CIF imports. What used to happen is the insurance amount, the cost which was incurred on the freight amount was borne by Mr. A. Was not borne by Mr. A. Mr. B, he used to pay a lump sum amount to Mr. B, which was inclusive of the freight charges. When the goods used to reach the custom station of India, when they used to come for custom clearance, Mr. A had to pay IGST for the clearance of good. Then the authorities used to charge a freight, used to have a deemed freight charges. They used to take some notional expenses as freight charges, and they used to levy, A had to pay IGST on that component on a reverse charge basis also. This was challenged in a famous Supreme Court case. Now I'll read this. The liability casted on the importers on the services supplied by a person located in non-taxable territory to a person located in a non-taxable territory. See, the liability casted on the importers on the services supplied by a person located in a non-taxable territory. A is an importer. He is using the services which are supplied by a person who is located in a non-taxable foreign shipping line, who is already located in a non-taxable territory, to a person located in a non-taxable territory. A is importing certain goods from B, who is the foreign supplier, using the services of the foreign shipping line. by way of transportation of goods by a vessel from a place outside India up to the customs station of clearance in India in case of CIF imports under reverse charge has been terminated. The amendments come after more than a year of Supreme Court's judgment in Union of India versus Mohit Minerals Private Limited. This is a famous landmark case. In case of Mohit Minerals, the judgment has been passed in case of Mohit Minerals Private Limited, wherein the obligation to pay tax on reverse charge has been terminated. I'll give a gist of this case. Mohit Minerals used to import coke. When he used to import coke, the freight charges were borne by the supplier, and the government asked for the they charged a deemed freight amount and demanded IGST on the same, wherein the assessee contended that the IGST has already been paid on custom clearance and there is no requirement for further payment. In the Supreme Court, it was held that the component of composite supply was taken into consideration. The Supreme Court held that this is a composite supply, and the freight and the supply of goods cannot be they are naturally bundled. They cannot be bifurcated. They cannot be dissected. They cannot be bifurcated. This is a matter of classic example of composite supply. So on those grounds, the demand was quashed and the law had to be changed because of this judgment. Thus, the reverse charge liability on imports which are made on imports of ocean freight in CIF related matters has been done away with. However, the FOB imports are still under RCM and RCM needs to be paid for this. Time for questions and answers. Hello. Hello.
Thank you, Darshika, for such a wonderful and knowledgeable session. The questions, when GST not apply on millets?
Sorry, the recommendation of the council is for millet flour, millet atta. This is not applicable to millets. No. And when it is not, the millet flour also, when it is not on any pre-packaged and labeled form, when it is in the pre-packaged and labeled form, millet flour also, 70% of the component should be millet flour. It should be in a pre-packaged and labeled form. Then 5% of the GST would be applicable, but not on millets, pure millets. No, this is not for the pure millets. Neither millet noodles nor millet, millet pasta or whatever.
It may be in the pre-packaged form or
it can be, yes, but it is not on millet. This exemption is only for millet flour, atta.
Right. Next question is there any change in bill format after 1st of October 2023?
No, none of the bill format is governed by Rule 46 of the CGST rules. And there is no change in the Rule 46 with effect from 1st October 2023. There is no change in Rule 46. So the bill format will continue to remain the same as it was before.
What kind of activities are conducted by railways on RCM basis?
With the 52nd Council meeting, the Indian Railways, all the activities of the Indian Railways have been covered under the forward charge mechanism. But previously, there have been certain activities which have also been covered under reverse charge mechanism. Previously, the transportation of goods and passengers was covered under forward charge. There were certain activities, for example, they were covered, also, even other activities were covered under forward charge except for activities of renting of immovable property. For example, Indian Railways has its own land which it used to give on rent for renting purposes. In that case, while RCM notification serial number 5 and 5A, the liability was cast in India when the Indian Railways is giving immovable property to a registered person. In that case, it was the liability of the registered person to pay the tax. That was under reverse charge mechanism. And when it was given to an unregistered person, the transaction was covered under forward charge. So Indian Railways, when it was renting out immovable property to registered persons, then it was covered under reverse charge mechanism.
Thank you.
Yeah.
Which goods are excluded from the reverse charge mechanism liability?
Pan masala, tobacco. There is this notification number 8, ice cream, pan masala, tobacco. These goods are excluded from this notification reverse charge mechanism.
What is the taxability of OIDAR services located outside India?
Online information and database access retrieval. As I said, like the services we take from Netflix, Amazon Prime, these are the service providers, online information database access service providers. When these service providers are providing services to unregistered persons, for example, if I take an Amazon Prime membership or a Netflix membership, these are services which are covered under here the OIDAR will be liable to pay tax under forward charge basis. They would be liable to pay tax on the services they supply to me. Also, when they are providing services to government agencies, there are certain government agencies which have been registered only for the purpose of collection of tax at source under section 51 of the GST Act. In that case also, the government agencies will also be considered as unregistered persons. So when online information and database access retrieval services are provided to unregistered as well as governmental agencies, then they would be covered under forward charge. However, when these persons provide services to B2B basis to registered persons, then they would be covered under reverse charge mechanism.
Darshika, yours PPT is in great demand. Kindly share these PPTs.
Okay, I will. Any more questions, ma'am?
No, that's all. Over to you, CA Poonam.
Okay. Greetings to all. This is CA Poonam Agrawat on behalf of the Women and Young Member Excellence Committee. I would really like to thank all the members for participating to the event. Thank you, our guest speaker, CA Darshika ma'am. Thank you so much, madam. You have provided a very deep, insightful knowledge towards this topic, that is the 52nd GST Council meeting, and you have provided a very good insight about the GST changes that has been made and the judgment references that has been made. It has been a very good helpful for us. Thank you so much. I would like to really thank my core team, the coordinators and the tech team for support and making this webinar a grand success. It's a remarkable webinar. It's the 75th episode for the Sky High Symposium. And I'm really glad that this platform is provided to all the women members and the young members to upgrade the knowledge. Thank you so much, Darshika ma'am, for your insight on the GST topic. Thank you. Thank you. Concluding, I would like everyone to participate and share the knowledge. Thank you so much, everyone.
Thank you so much.
Thank you so much.